The markets fall for a fourth consecutive day, but a late day rally mitigates what could have been a much darker showing for Wall Street. Nevertheless, minutes from the Fed's July meeting don't give anybody anything to cheer about. Now we enter a kind of intermission period before the next Fed bombshell hits the tape. This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And lest you think this intermission period is going to be uneventful, think again, because we have something to chew on in this intermission period that will give us perhaps some very important stage setting for what we are looking at when we get ready for that big headline on Friday from the Fed chairman. So, what do we have here in the intermission? Well, let's take a look first at the way that the markets performed today, get a sense for what it is that we're doing here as we follow this story since the beginning of the week, this Fed-oriented story, and then consider what might move the needle here before we really dig our heels in and get ready for Chair Powell to speak at the Jackson Hole Symposium. Here's today's performance. It's a soggy one for stock markets. S&P down about 0.3%, NASDAQ down 0.65%. Kind of a mixed bag situation on yields. The 10-year a little bit lower, the 2-year relatively steady, although skewed somewhat to the downside, but bonds ultimately within their recent ranges. The story in oil positive, but again, we're still hovering around that center line of the price range that's prevailed here for the better part of several months. If we kind of take a look at where oil is relative to where it's been, going all the way back to October of last year, we've kind of carved out a broad range between about 74 and 54 a barrel on WTI. The midpoint there is around 63. We've hugged that level multiple times here, and we're sitting right at it. And so it doesn't really seem as though what we have is a situation where there is any kind of meaningful conviction from crude oil to what is going on, either around markets from a risk sentiment perspective or around what's going on in the geopolitical side of things. Crude oil seems broadly listless, and in fact has been kind of oscillating around these levels now, basically going back at least to the beginning of this month. So we do get a swing, but doesn't look like there's much to make of it. It's a similar story with gold, which manages to rally today, but again has been listless in a narrowing range going back to about the second half of April of this year, sort of in the wake of the Liberation Day shenanigans, and increasingly is stuck in a still narrower range, the broader one somewhere between 3,500 and 3,100. We're increasingly getting squeezed into a narrower band between 3,250 or so and 3,450, and even still narrower recently between about 3,370 and 33 the figure. Maybe a little bit higher, 3,320 or something like this. So we get a swing, but it isn't very convincing. The dollar is flat. Bitcoin a little bit higher after a round of selling that's mostly mirrored what's going on in equities. So a soggier day, but not so convincing when you look beyond stocks to say, oh, this was a very clearly risk-off day, as opposed to, let's say, yesterday. But when you look at the charts here, you start to see that loss of momentum. So you can clearly see yesterday was a much more engaged sell-off. Here we tried for it, and that's where you get this lower wick, but ultimately this sort of anchoring axis, give or take, for the S&P, that ultimately holds, and you can kind of see where the inflection point on sentiment probably sits here. So obviously very crude artwork here, but you sort of get the sense that somewhere here there is a kind of inflection, and we can see it as resistance, then as support, then as resistance again, now acting as support. And if you wanted to kind of make the case that this thing is rolling over in earnest, you'd have to say, well, the last time that we had a meaningful uptick was the CPI report on the 12th of this month, where we ultimately went on to break this high. We have since failed in the breakout and come back to essentially the starting line here. Moreover, if you wanted to see a convincing reversal, you'd probably be looking for a break of this here. And that's somewhere around, let's call it 6250 on the S&P, which would be kind of the larger bottoms here and here. And that would be kind of where you'd say, okay, a top has been formalized, if you were to take all of this out and end up somewhere over here. Nevertheless, this market has not managed any upside since this CPI data. And if not for that, it has been listless and then erring down. The NASDAQ is a similar story. Again, you have this kind of center axis that seems to be holding around here. This is your big support, somewhere around 22.7, 22.8, right where these lows are. But again, since the CPI number, relatively soggy. Now, why this rebound and why the sell-off in the first order? Well, it began with tech shares, much as it did yesterday, and that's not surprising when sentiment sours in a market that's overwhelmingly tilted in one direction, where one sector has been the driving engine to such an extent that nearly all market cap is now stuffed in it. Of course, we're talking about tech, which is so wildly outsized in terms of its influence after these recent years of gains. As compared to anything else, it would make sense that when people de-risk more generally, tech is going to be impacted more. That's where most of the exposure is. That isn't necessarily negativity about tech itself, though, of course, OpenAI CEO Sam Altman saying yesterday that the current situation is analog to what happened with the dot-com bust. That's probably not helpful. Nevertheless, you do get this kind of a tech-powered sell-off today that seems not to follow from any new comments, but rather from the idea that if the market is going to be getting a little bit more defensive, it will be tech that will be most impacted. And then, of course, you get the FOMC minutes that we were looking at, and they don't offer much help, and we'll take a look at why momentarily. But ultimately, as we get into the end of the day, the upshot holds. The Fed is still overwhelmingly expected to cut rates in September. The risk this week was that that idea might be under question, or at least that the Fed's ability to convince the markets that it means business in starting a rate cut cycle, that's in question. But the actual probabilities for September have been relatively little changed. We're a little bit lower today at about 83% chance of a cut than we were yesterday, closer to 84, 85. But that hardly matters here. It's more of a rounding error than anything. We're still overwhelmingly convinced that this cut is coming. And so perhaps that's why the markets feel relatively okay about coming off the lows and having a much smaller down day ultimately than it looked like earlier. Moreover, the actual architecture of expectations for this year and next has been relatively steady also. We can see the market is anchored around 50 basis points in cuts this year and has been so basically since May. That, of course, lines up with where the Fed is. They're looking for a move from a median level of 4.4 down to 3.9 for this year. That's 50 basis points. So for 2025, the markets and the Fed are basically in line. We still also have this wide disparity for next year, where the market is overwhelmingly biased in favor of 3 rate cuts. 2 of them are fully baked in. The third has a probability of close to 70% of occurring, so relatively convincing. Whereas the Fed is only looking for 1 cut, from 3.9 to 3.6. That's a single 25 basis point cut rounded off. So we're looking at a much more dovish view from markets than we are from the Fed, and this perhaps is why these minutes didn't go over well today and why the market is so worried about this to begin with. We see that the majority view in July was that the upside risks to inflation are greater than the downside risk to employment. So it tells you the Fed is biased toward fighting inflation, that is, toward cutting rates more modestly, if at all, rather than toward boosting growth. They continue to think themselves well positioned to respond flexibly, so they're not feeling a sense of urgency, though they do see that the risks to both sides of the mandate are elevated. We also see that the 2 dissenters that we saw, Chris Waller and Michelle Bowman, the 2 governors that dissented in favor of a 25 basis point rate cut, we see that they are on an island. If that were indicative of a broader dovish skew starting to percolate on the committee, these minutes suggest that that's wishful thinking. There is no percolating. They really are by themselves here. Moreover, when we start looking at the details here, we start to see that their difference is perhaps not coming from some sort of a philosophical disconnect on the committee, but rather from more tactical timing expectations. So we see here that some participants thought that it was not feasible or appropriate to wait for full clarities on tariff effects before cutting. We likewise see that slower jobs growth isn't necessarily being attributed to a weakening economy, but rather the crackdown on immigration, even though clearly everybody is noticing that there is a slowdown in hiring. What's interesting here is that there is a reluctance to both hire and fire amid elevated uncertainty. And this is perhaps where things are especially interesting. So it's not as though the Fed is seeing weaker jobs numbers and saying, oh no, we have to fight a slowdown. It's more like they're saying this uncertainty has put a lid on turnover, and where this is impacting kind of the regular operations of staffing as need be for demand, it is through reduced immigration and a lack of supply, not through some sort of a conviction level on demand. We then see that we, from some corners, have an appreciation for the risks to long-term inflation expectations, and that those risks are being held at the same time that we have the appearance that growth is going to remain low in the second half of the year. There are some worries here, likewise, about elevated asset values, so stocks at record highs, basically. And likewise, an interesting statement about where we are relative to neutral, which seems to give a sense that there's not that much scope to cut rates when the cuts come. Because if the current Fed funds rate is not far above neutral, and we saw here that policy is being seen as moderately restrictive, well, then we don't have any hikes on the horizon as we worry about all of these inflation concerns because policy is already mildly restrictive, nor do we have a lot of room to cut because we're not that far off neutral and we don't want to let these inflation expectations out of the bag. And this is where the next 24 hours get a little bit spicy. It's very easy to look at this and say, well, since this, we have had a second quarter GDP number, or at least the day of, actually. This obviously didn't factor directly into forward thinking, but the same day, as a matter of fact, as this data came out, we had second quarter GDP data that showed us weak consumption. In fact, the weakest 6 months of consumption in the first half of this year that we've seen since the first 6 months of 2020, the COVID recession year. We also have obviously seen a deterioration in jobs numbers. And so it's tempting to say, well, all this hawkishness in these minutes, all this reluctance, it's old news. Now that more data has appeared, the Fed is going to be readier to go. And to test that question, we're going to have the next round of Purchasing Manager Index numbers from the major economies, excluding China. China's a little bit later in this PMI reporting cycle. They're coming next week in dribs and drabs, by the way. But the two things that we're going to learn over the next 24 hours will be how Europe is faring and how the US is faring, most importantly. And of course, the reason that this matters so acutely is because China, the Eurozone, and the US, as we've said time and again here, represent 58% of global GDP. These are by far the driving engines of global demand. And that's even before we consider that the rest of world, 42%, depends on the large three and exports into them as the main engine of demand generation for themselves. So clearly, these are important numbers because if the markets in fact say, well, look, we already have Europe near standstill. And of course, as ever, we have this centered around the 50 line, where that's neutral. Above 50 is growth, below 50 is contraction. The farther you go above 50, the faster the growth. The farther you go below 50, the faster the contraction. The story on these PMIs for the last month was China and the Eurozone are anchored within a hair of 50 and have been at least all of this year and most of last year. So there's hardly any growth there. They're basically idling. In the US, growth was the main offset, the single leg of this three-legged stool that was holding up last year. There was a tariff scare at the front of this year, and S&P Global's version of this data would tell you that scare has been shed, and we're back to basically where we were toward the close of 2024 on U.S. economic growth dynamics. The ISM report, which is a rival view on PMIs and comes out later, would tell you that actually the story is darker. That you're basically at standstill on services and you're deeper into a contraction on manufacturing in the most recent numbers. In other words, it tells you that if the sole concern for global growth here is the US falters because then there is no safety net, buckle up because the US has started to falter. Which is what makes these numbers so very interesting and makes the Fed such a central point to this entire conversation. If the only point of support for the global economy is US growth, you do not want to see that US growth go south lest you risk a global recession. And if you do see it go south, you want a Fed that is quickly responsive and not dithering. Take a look at what we have expected for Europe. It is versions of standstill again. So going from the low 50s to a touch above in a adverse direction, let's say. So slower expansion overall, and again, hugging 50. Faster contraction on manufacturing, slower growth on services. Looking at the US numbers, we have a forecast for a significant downstep in services, faster contraction in manufacturing. There's not an official forecast for the composite, but it doesn't take a genius to see that if the two constituent parts here are ticking down, so will the headline number. And herein is where things get curious. If this ticks down in this relatively modest way, well, then maybe the Fed can in fact be convinced, and then maybe in fact these minutes are old news. And something more dovish is coming from Fed Chair Powell when he gives the lens adjustment that we look through to judge what data means and where policy is broadly pointed when he speaks at the Jackson Hole Symposium. That's coming on Friday. If these numbers are hotter than expected, well, then those rate cuts are probably not coming. At least not in the way that the markets expect. You probably still get the September cut because markets are fairly convinced about it and about this year. But the transition of a Fed from 25 basis points to the market view, 50 erring on 75, that's probably not in the cards. And there's a level of disappointment there because the markets clearly want these cuts. Else they wouldn't be here. So what we're looking at then is scope for disappointment going into Jackson Hole if the PMI data were to be warmer than expected. And then if the PMI data is weaker, but a lot weaker, much weaker than expected, well, then you really run into Jackson Hole with some concerns because then the market's position gets validated. They get to pat themselves on the back and say, oh, good, we knew we needed these rate cuts. But then, of course, the risk is the Fed isn't there, which is precisely what these minutes suggest. That maybe, yes, you get the 50 basis points this year. That much has been very clearly understood and priced in. But will they deliver next year? If the numbers are particularly weak, but the sense is that the Fed is not convinced, well, then where are you? And that, of course, was the story looking at these PMI numbers here. The Fed clearly at the start of this year was not convinced by a pullback in PMIs and remains unconvinced still looking at these minutes as of last month. Meanwhile, we already see the architecture of a slowdown. We looked at consumption here. We can see that consumer sentiment is already fading as inflation expectations rise. That's happening because goods inflation from the tariffs is accelerating and has in fact now hit the highest level in 2 years. We see that that's just the tip of the iceberg because, as we saw from the PPI report, businesses are starting to pass through inflation costs finally to consumers. Consumers, of course, being savvy, have noticed, hence the rise in inflation expectations and the downtick in sentiment. So the architecture of an economic downturn is here. If the Fed does not take the hint and meet the markets closer to where they are, there's disappointment to be had there, which is a problem for stock markets and probably beneficial for the US dollar. How much disappointment and how worried the markets need to be will be a check on the state of the economy, not just in the US but globally. And these PMI numbers are that over the next 24 hours. With that, we have macro money for today. As ever, we are here Monday through Thursday after overtime, show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I am likewise on with Chris for Futures Power Hour Mondays and Fridays, back with Chris and Tom for First Call Sundays, writing for the news and insights portion of tastylive.com, and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money's back tomorrow. Happy trading.